Hi, my name is Kunal Gupta. I'm the CEO at Polar. We're a global technology company working with publishers and advertisers. And I've been publishing a quarterly stated digital media report, which really looks at macro level trends affecting the industry. Personally, I have the luxury of getting to spend time with publishers and agencies and platforms around the world. Our business operates in 20 markets. I live in New York. We've got offices in 4 countries right now. And the report today is going to really talk into 2020, a couple of key trends that I think are worth paying attention to and that I'm definitely watching. I recently became a yoga teacher and I've been teaching meditation for a couple of years. And I've really enjoyed these practices. And one of the things that they've done is they've exposed me to some different philosophies and ideas around yogic principles. And one that's I've brought into the industry that we live in and work in is this notion of truth. And we believe certain things are true because we've been informed and educated and inspired in a certain way. And we might discover new information. And we live in a reductionist society. So if I believe this is white, then black is different than white. The idea that I'd like to plant with all of you as you walk through this presentation or listen to this recording is, can this also be true? This idea that there could be multiple answers and this idea of openness to new insights that might challenge and might be against what we've believed to be true so far. So can this also be true? So let's jump into it. There are a number of topics we're going to cover today. The first one we'll start by looking at some of the industry data just to understand where is digital advertising spend going. I'm going to then go into Facebook and talk about how I believe Facebook's become the new IAB, highlight a couple of the new platforms that are worth paying attention to and a few key stats that have caught my attention, talk about stories and why I believe this is going to essentially be the future of everything, talk a little bit about TV and how that's being disrupted. The search industry is actually being transformed now for the first time in probably 5 years. So I want to highlight a few things to pay attention to there. I think Google long term is going to potentially get out of the ad tech business, and I'll tell you why I think that. We've seen a lot of media consolidation in the last few months get announced. We're going to see a bunch more get announced in the next few quarters. Talk about what I think is actually happening behind the scenes. And finally, we'll end around this idea that the cookie is crumbling and what that actually means for the rest of the industry. So let's start by talking about ad spend and at a high level, this idea of show me the money. Where are marketers and advertisers putting their spend? So this year, the duopoly of Facebook and Google will take about half of the digital advertising market. The digital ad market is growing at 18%. That's about the same growth rate as Google's ad business. Facebook is growing at 29%, almost 50% faster than the overall market. Now, within the entire digital market of about $330 billion, half of that's digital, and then so half of the total market is digital, and then of that, 65% is on mobile. Mobile video is the fastest growing subsegment of digital advertising, and I think that's largely driven by platforms like Facebook and Instagram and Snapchat. And still, about 2/3 of advertising online is performance based, with 1/3 is focused on brand spend. So this year, for the first time, digital across half of ad spend, and there's about a dozen countries: China, UK, Norway, Ireland, Denmark, Sweden, Australia, US, New Zealand, Canada, the Dutch market, and Russia that will cross over 50% this year. So that's a key milestone. I was just in South Africa, and digital is 28% there. TV is still the dominant platform, but it's growing very fast. So we're going to see a lot of markets tip over this 50% mark. And the UK is already at 66%. So 2/3 of all ad spend in the UK is on digital platforms. Now, within digital, I think it's worth looking at platforms, what I consider essentially platforms that have over $1 billion in ad revenue. So this year, I believe about 9 platforms are going to cross $1 billion in ad revenue. And in the presentation, I break out Facebook's business into different business lines like Facebook versus Instagram, and then Google's business into different business lines, Microsoft's business, etc. So who are those 9 platforms? So number one is Google. Their search business, about $72 billion. YouTube, about $20 billion. Their network business, which is running ads on the internet outside of O&O on a net revenue basis. So after the traffic acquisition costs and property payments, it's only $7 billion and growing about 15%. And then Google has a bit of other revenue through mail and maps. So Google's total ad revenue is $135 billion. The company is growing ad revenue at a rate of 17%, and their growth rate is actually accelerating. It was 16% last quarter and then 15% the quarter before that. Facebook's ad business is now $70 billion on a run rate basis. About $10 billion of that $70 billion is on Instagram. Facebook's total ad business is growing at a rate of 28%. They just released earnings recently. And by next year, Facebook's total ad business will be bigger than Google's search business, making Facebook the largest ad platform if you were to split up Google's business into different revenue lines. So you've got Google at 135 total. You've got Facebook at 70 billion. Next, you've got Amazon, about 14 billion. Microsoft, you've got the Bing business and the LinkedIn business combined close to 9 billion. Verizon at about 5 billion. Twitter, about 2.8 billion. Their recent results, disappointing on the growth rate. Their growth rate is only 8%. And then Taboola and Outbrain announced a merger. It hasn't gone through yet, but assuming it does, a few people estimate that their revenue will cross about 2.4 billion. So they're actually quite large in scale. They're in the top 9. And then Snapchat had very impressive earnings. 1.8 billion is their run rate, growing 50%. Pinterest also impressive earnings, 1.1 billion, 47%. So those are the top 9 platforms in digital advertising that have crossed $1 billion. That will cross $1 billion in revenue this year. And that's what I believe everybody else should be thinking about in the industry. Is like, am I going to be an ad platform? Am I going to cross $1 billion in revenue? Okay. Next theme that I'd like to speak about is why I believe Facebook has become the new IAB. So pretty much all ad innovation is happening inside social platforms. And when we talk about ad innovation, I'm focused on creative and format. So eMarketer has shared that 80% of time we spend on our phones is inside of 5 apps: Facebook, Instagram, YouTube, Snapchat, and Twitter. None of these apps have banner ads. So social platforms continue to innovate. They're building amazing tools. They're encouraging and pushing the bar on creative. Stories is an example of that. Vertical video is an example of that. And the IAB over the last 10 years has been really focused on workflows and efficiencies and programmatic, and has completely ignored ad creative and format innovation in a way that's scalable and valuable for advertisers. So I think the IAB has left creative behind. And if you look at where ad spend is going, like of the 9 platforms that have crossed $1 billion, a small portion of Google's business is the only part of the 9 platforms that actually supports IAB formats. So the vast majority of internet advertising does not use IAB formats. So that's where I believe Facebook is actually the new IAB in terms of formats. So we've looked at a lot of data recently, and it's been clear that 70% of performance is creative. And we forget this on the internet, that 70% of performance is creative. In the presentation, I highlight a few visual examples. If you look at a number of advertisers in financial services, in sportswear, in electronics, in automotive, in retail, CPG, like every single category, you look at the quality of ads they're producing on the web, as in IAB formats, versus the quality of ads they're producing inside social platforms like Facebook, it's night and day. And in many cases, you wouldn't even think they're the same advertiser. Brands have generally in-housed social creative. They see it as important, they see it as valuable, where they still outsource display creative because they see it as expensive, and frankly, they don't care about it. The number of campaigns that start in social with social format and social creatives and stay in social is very large. There's a lot of campaigns that never actually see the web, because of creative. The creative inside social is very different than the creative on the web. So 70% of performance is creative. Creative matters. And social today gets the best creative. And I think that's a big, big reason for why social does so well for advertisers. And then the last piece I'll mention on this topic is that Facebook has made it very easy to buy advertising. So the majority of Facebook's $70 billion in revenue now comes from what they call the mid-market, which means non-Fortune 2000 advertisers. So these are medium-sized businesses and small businesses, local businesses, self-serve tools. They're amazing. Like, you can buy an ad on Instagram on your phone in under a minute. If you haven't done that yet, I would encourage you to try it out. Buy an ad on Facebook and see what that experience is like. I've had everybody on my team do that several times over. It's slick, it's clean, it's easy. And just like Facebook has been training consumers on here's the new standard for advertising, Facebook has been training advertisers, big and small, here's the new standard for how you buy advertising. The way you buy like a Facebook ad, even on your phone, night and day to how you buy programmatic ads or ads through a traditional IO process. Okay, next topic. I'd like to highlight the new kids who are turning heads and the new platforms that are starting to introduce different ideas. So TikTok, it's not social media. It's described as social entertainment. So I'm still frankly wrapping my head around how it's used, and I've started to play with it. But TikTok had more than 1 billion downloads. So the world has 7 billion people, maybe 8 billion people. 1 billion people have downloaded TikTok in 150 countries and 75 languages. So the maker of TikTok is a company called ByteDance. It's a Chinese company. They were recently valued at $78 billion. And they're the number one downloaded app in the App Store. Zuckerberg, in an internal town hall that was leaked, he shared that I think this is a real thing. It's good, referencing TikTok as a threat to Facebook. Next is Reddit. So Reddit is actually becoming the fastest growing platform. So they have 330 million users. That's more than Twitter, LinkedIn, Snapchat, or Pinterest. So let's let that sink in. Like, Twitter's audience is massive, and they're active. Their revenue is not massive yet. They're by 2 years from now, they're expected to cross $250 million. So they're a long ways away from getting onto the $1 billion club in terms of being an ad platform. But they're definitely a consumer platform for attention and engagement. And they have 1 billion monthly video views. They're the 4th most visited website in the US overall. So the audience is massive. I think there's a monetization, challenge that they have. And then Pinterest has kind of quietly built a $1 billion ad business, and they haven't even yet expanded internationally. So that's the most interesting part about Pinterest to me. We've got 300 million monthly active users, and it's growing 30%. But 72% of their users are outside the US, but only 9% of their revenue is outside the US. So they've been able to build a $1 billion business predominantly in the US off the back of 100 million people. That talks to engagement and talks to the value of their users in the eyes of advertisers. So as online commerce continues to become more and more important, I think Pinterest is going to ride that wave. We're going to see in markets where e-commerce continues to be really strong, Pinterest continues to do really well, because it's kind of the start of the discovery process, and maybe even a couple more stages in the process. But Pinterest is really, really well positioned to capture part of the customer journey as e-commerce continues to grow. Okay. This is something I've been paying a lot of attention to recently, and I think it is going to become the future of everything, and that's stories. So advertisers have embraced stories in a big, big way. Over 500 million people are using stories every single day inside Instagram. That's like 1 in 15 people around the world go into Instagram stories every single day. And then 190 million people use Snapchat stories every day. I saw in their recent earnings call for Snapchat that the average Snap user goes into the app 30 times a day, and it used to be 25 times a day. From a digital wellness perspective, that's a little scary. If you're a parent with kids who are on Snap, that's probably a little scary. But from an advertiser perspective, that's quite impressive. And I've played with stories like the quality of content in stories is still pretty weak, but I think that speaks to the format, that the format is so engaging and that it builds curiosity, it builds attention, it drives engagement. I think stories are actually the closest thing we have to TV advertising online. Pre-roll video ads keep getting shorter and shorter, and the biggest platform like YouTube, they're skippable, and Facebook, nobody sees them because people scroll so fast. You've got rich media ads, which are hard to produce, this banner blindness. So when we think of like online ad formats, I think stories is the closest thing we have to TV advertising, where the advertiser can actually tell a story and have a narrative and get that full engagement, because stories are generally full screen, it's on your phone, you're fully captive. So I think we're going to see stories. I think we'll see TV budgets over the next year, the same TV campaign, sorry, starting to end up with stories executions for the web. Almost half of Instagram content is now stories from an advertiser perspective. So stories, they definitely encourage more engagement versus passive scrolling through feeds. And on the last earnings call, Facebook executives used the word stories 39 times. Over a 60-minute call, they referenced stories 39 times. And they referenced stories more than they referenced trust, privacy, safety combined. So that just speaks to how important stories is to Facebook. And Facebook's doing the hard work. They're training consumers on here's the new way to consume content and advertising. And they're training advertisers, here's the new format for the internet. And then stories are now starting to become shoppable. It's the fastest growing, video format when you have shoppable video ads and then story ads into next year. Okay, now moving into video. So video is starting to pivot, and we're starting to see a lot of influencer marketing and video overlap. So 70% of advertisers are using digital video with influencers, and then 43% of advertisers will increase their spend of digital video with influencers. So I thought that was a really interesting insights. And that number is 51% of D2C brands are increasing spend of influencers with video. So influencers, stories as a format, and then video as a medium combined is a winning formula that we're going to see a lot of marketers invest in. So connected TV may kind of very quietly become a $20 billion market by next year. And I think what's most interesting is that it's not all digital budgets. It's actually like capturing linear budgets. So there's 190 million people. It's about 57% of the US population will be addressable through connected TV this year. And an eMarketer survey of, I think it was a few hundred executives, advertising executives and agency execs, when they asked about the challenges with CTV, cost, measurement, and scale were the top three challenges. So the cost being that it's expensive, inadequate measurement, and then lack of scale through kind of single platforms. There is no Facebook, Google, or Amazon for connected TV yet. There's a lot of people claiming they are, but there's not. So there's that lack of scale, and they're all measuring things slightly differently. The pricing is all over the place. So there's a lot of things that we'll see mature, I think, over the next 12 months here. And then in the last little while, we've seen a bunch of M&A activity in the video ad tech segment. So Xandr bought Clipped. So Xandr, part of AT&T, Warner Media. Roku bought DataZoo, and I think we'll see a bit more consolidation here, as there is no major platforms yet in CTV, but there are a number of companies vying to be those platforms, so the race is on. Okay, search advertising. So Google has been the king of search. Search has been the cash cow for Google for the last 20 years, and I think they're now finally going to get challenged. So search is 45% of all digital advertising. So it is the lion's share. It's bigger than social. So why is it continuing to grow? Well, consumers are making more purchases online. So retailers are willing to pay a lot more for those clicks because it's closer to purchase versus discovery. I think the algorithms that search engines, especially Google and Amazon have, are getting better. And part of that is the creepiness of Google, and that they know, my history of location. They're probably reading my email. They know what videos I watch. They know what websites I browse. So the algorithms are getting better and better. Part of that is the creepiness factor. And then D2C brands. A lot of them started on Facebook, and then now in social, the next channel they're investing in is search. So that's creating more competition in the auction, which is driving up prices. So people are doing more searches, the searches are more effective, and there's more competition for search dollars or search media. So search has not slowed down in the growth rate. It's continuing to grow at the same rate of the overall digital ad market. So Amazon is now the number 2 player. We've always thought of kind of Google owns it, and then there's a big drop off to Microsoft and Yahoo, now Verizon. But Amazon is actually now twice the size of Microsoft, and it's bigger than everybody else outside of Google and search combined. So Google has about 73% of the search ad market in the US. Amazon has 13%. And the big one that nobody's really talking about is Facebook. So Facebook has entered the search industry. And I think they're going to give Google a run for their money. So they very quietly announced, probably 2 weeks ago, the introduction of search ad placements. So when you make searches on Facebook for friends, for events, for places, inside Instagram too, we'll start to see search ads. Now, a big way that advertisers spend inside Facebook is a feature called automatic placements. And that's where you don't actually choose, do you want to be on Big Blue, the Facebook app? Do you want to be on Instagram? Do you want to be in Stories? Do you want to be in Messenger? Do you want to be on Facebook Audience Network? Automatic placements is you giving Facebook control to decide where does your ad perform the best, and they will do that. Now, behind the scenes, they're also managing their auction, they're managing supply dynamics, they're managing margin. So it's a very smart move on behalf of Facebook. So now, by default, when advertisers use automatic placements, the ads will start to appear in search ad placements. It's a really smart move for Facebook. That's going to very quickly funnel a lot of money into search on Facebook's platforms. That's full margin for Facebook, and I think they're going to become the challenger inside the search ad industry. And the potentially scary part is the attribution tech that Facebook has. I think they'll start to take credit in some pretty creepy ways. So let's say I went to Nike.com to browse for some shoes, and then I searched, a random event on Facebook, and they show me a Nike ad. Even though I don't click that Nike ad, Facebook might tell the advertiser, hey, Kunal went onto Nike.com, Kunal saw this ad on Facebook, even though it may have happened in the reverse order, or even though I did not click on the ad. So I think Google and even Amazon are going to run for their money with Facebook now entering search. Okay. What is Google saying? So Google's ad tech business is only a 30% margin. And ad tech meaning DFP, Google Ad Manager, DV360, all of Google's ad products that monetize the internet. Versus Google's O&O business, which is search, YouTube, mail, maps, and others, is an 87% margin business. On their last 3 earnings calls, so that's the last 9 months, their CFO has very clearly said that they're trying to shift revenue to a favorable mix to O&O, which is higher margin, versus network, which is low margin. So a 30% margin business versus an 87% margin business. So the ad tech business for Google on a net basis generates about $7 billion a year. Search is 10 times bigger than that. YouTube is 3 times bigger than that. And their cloud computing is actually bigger than their ad tech business on a net revenue basis. A lot of key executives have moved from Google's ad tech business to their O&O business. Neil Mohan gets credit for really building Google's ad tech business from a product perspective over the last 10 years. He's now Chief Product Officer for YouTube. I think there's going to continue to be a lot of antitrust and competition and regulatory pressure on Google's ad tech business and the practices that they employ there. And as that pressure continues to mount, I would not be surprised if some lawyer or some executive inside Google raises the question, is this even worth it? They've got a $150 billion business in total, and ad tech is $7 billion on a net revenue basis. Is this even worth it? The legal risk, the financial risk, So I point to Google Plus as an analogy. So Google Plus wasn't really successful, but they still kept it around for many years. And they only shut it down the moment there was a data leak. There was a privacy issue, and then overnight they just shut down Google Plus. They said it's just not worth it. I don't know if they're going to shut down the ad tech business because of a privacy or data issue, but I would not be surprised if they sell the ad tech business to like a private equity firm, because it's pretty profitable and it's a decent sized business. But from a Google perspective, I think it exposes Google's parent company to an incredible amount of risk, and I think they're going to continue to double down on their O&O business, become a closed platform, and get rid of the ad tech business long term. And what are they going to replace that with? It's cloud computing. So on the last earnings call, Google's CEO used the term cloud 30 times. He used the term ads and advertising only 17 times. Like that is all they're talking about. They've made so many key hires. The revenue growth rate is crazy fast on cloud. It's an $8 billion run rate business for them today. They spent $2.6 billion buying Looker. So I think they're going to keep doing M&A in the cloud computing category. They haven't done any M&A in ad tech recently. And analysts are predicting that Google's cloud revenue might be 18 to $20 billion by next year. So that'll be 3 times the size of ad tech on a net basis. That'll be the same size as YouTube. So cloud is Google's play to frankly take a piece of everything happening on the internet, not just the advertising on the internet. If I was in their position, I would do the same thing, is double down on cloud, which they are, and pull out of ad tech, which I think they will. Okay. Media consolidation. We've seen a lot of it in the last few months announced. And as I mentioned, I think there'll be a lot more announced in the next couple of quarters. So recently, this is a bit of a US lens. So Group 9 bought Pop Sugar, Vice bought Refinery Media, Fox bought New York Magazine. Dotdash's CEO Neil has talked publicly of they're continuing to look for assets to acquire. Bustle over the last year has continued to buy up distressed media assets. So everybody's got this slight variation of the playbook, but there's been a lot of consolidation. There's been a lot of activity. So why is that happening? Well, I think there's 3 things that I've noticed. So one is this idea of getting bigger. So more scale means better being able to compete with Facebook and Google. But the question I'd ask is how big is big enough? Profitability over growth. So a lot of these companies have been focused on growth and unprofitable in the last probably year or 2 years, starting to become profitable or close to profitable. So as they've now merged, is that going to lead to job cuts with this quest to become more profitable, become more efficient, and invest more strategically? So I think that is a driver for some of this M&A, for some of the cases where they see as a chance for efficiency gains. And the third one, which is worth saying, is I think investors have lost patience. A lot of the investors of these companies are big traditional media companies and media owners. I think they are looking at their investments and saying, okay, we made certain assumptions going into this. Some of them have come true. Some of them have not come true. Let's chalk it up to learnings. If we can break even, make a bit of money or recoup some money, then they're happy. So I don't know if a lot of the investors made a return, but I think they were looking for closure. A lot of them have been in it for a long time. So in this idea of using M&A to get scale, I want to highlight an example that's counter to the trend. And full disclosure, Polar in our business is involved, commercially with this example, which is the Washington Post. So the Washington Post, owned by Bezos, recently announced Zeus Prime. And that's their vision to build a trusted publisher network and platform that gives brands access to scale on what I call the trusted web. So the strategy, though, is instead of buying publishers, to enable publishers with technology, and specifically with ad tech tools that fit nicely into the current stack, but then also enable them to access potentially new revenue streams at higher margins and values. They've done this playbook already over the last 5 years. They've launched the ARC publishing unit. It's a content management stack. They now power the websites for 175 publishers. It's a different division inside the Washington Post. It's a very large division with over 100 engineers. So they've built a content tech business for the publishing industry, kind of like AWS for cloud computing. They've built the CMS stack, which is Arc, and now they have talked publicly about a vision to build an ad tech platform for the publishing industry, one that's focused on trust and quality and premium. So Polar is involved with the ad tech stack. They've partnered with us to help build some of the technology there that was recently announced. But that's a different strategy to get scale, is through tech versus M&A. And final point is this idea that everything does change. So user privacy will continue to dominate in 2020. So GDPR is live. I think enforcement is going to start to come. We're going to see the next wave of enforcement. CCPA, California Privacy Law, is about to go live. Apple's ITP, Intelligent Tracking Prevention, it has the word prevention inside the acronym. That continues to get stronger and stronger. And Google, well, we're not really sure if Google likes cookies or doesn't like cookies. They've said both, and we're not even sure if they consider themselves first party or third party. But needless to say, powerful tech companies and powerful regulators are saying privacy is important, and the way the ad tech industry has been functioning is not cool. So the ad tech apocalypse is coming, and this is around the cookie. So Google has done tests, and they claim publisher revenue decreased 52% on impressions without cookies. Criteo, the world's largest remarketing platform, has been going through a number of challenges. Their revenues went down 5%, and analysts talk about it being attributed to Apple's intelligent tracking prevention. And then publishers in general have been reporting 15 to 20% lower revenues on Safari, where cookies are challenged. So these are just some of the early signs. I think the entire industry over the last 10 years has built up lots of tech and assumptions around the cookie. At a foundational level, the cookie is going away. That's my belief. And then that's going to cause rumbles and an earthquake for the entire industry. And ultimately, this is actually going to benefit Google and Facebook. So like getting quality third-party data at scale on the web will be very, very hard. Martin Sorrell, S4 Capital, former WPP, he's now become a believer of Google and Facebook, where before he was a critic. And this idea that Facebook and Google have deterministic data, so deterministic meaning the user is logged in, so it's not assumed through a cookie or other related technologies, the user is logged in. So I know who you are because you're logged into my site, that's Google and Facebook, or you're logged into the browser so I can understand your web activity. And the two ingredients I'm looking at here are like deterministic data and then doing that at scale. So being able to find a lot of people. The publishers, for example, with paywalls are now building deterministic data, and that I know who you are, you're logged into the site. And if I've done a good job, I've collected a bit of understanding of who you are, but they don't have scale with the paywalls. And then other people, the cookie has scale, but it doesn't have deterministic data. So Google and Facebook and related platforms are the only ones that actually have deterministic data at scale. And I'm posing the question, if we're going to ask in a few years, if like a documentary is going to come out saying Google and Facebook invented GDPR, or they inspired it. Because we're going to look back a few years from now and say like, wow, over the last 5 years, GDPR led to so much incremental gains for Google and Facebook and completely squashed competition when it comes to ad targeting. So they definitely have the most to benefit from what's about to happen in the industry. So that's the report. That's the latest view of what's on in my mind, and it's a global view inspired by publisher, agency, and platform conversations that I'm having every single day in different parts of the world. Been lucky to be in this industry for the last 10 years. I'm very lucky to have access to leaders across the entire industry, and lucky to have a mindfulness practice that gives me the tools to stop, to pause often, and reflect on what's happening in the industry and what might happen into the future. It's such an interesting time. It always has been, but this is no different to be in this industry. There's so much change and dynamism, and I think that's what keeps a lot of us enthused and excited about this industry, and trying to understand the signals from the noise and trying to make some bets as to where things may be going. So that's the state of digital media. Thank you for your time and attention. You can send me your comments and feedback, k@polar, polar.me. You can follow me on LinkedIn. I share updates quite often of what I think is happening in the industry. And then I keep a leadership blog called findfocus.today, findfocus.today. So findfocus.today. Talk about my interest in mindfulness and leadership and technology culture. So thank you for your attention, and looking forward to hearing from you.